Welcome to Building Your World, the commercial real estate development and investment podcast. Here, you can find insightful discussions covering industry-related topics across all asset classes and markets.
Hello all and welcome to the podcast. Thank you very much for tuning in. This is a very special episode because it is our very first episode. My name is Nicholas Long and I will be your host alongside McKay Brabham and Will Ellis. We'll be introducing ourselves in just a bit, but I wanted to provide a brief synopsis on what this podcast is all about and why we decided to start it. So jumping back a ways, the three of us met and studied together in grad school at Clemson University, where we received our master's in real estate development. Upon graduating, we each went off to work in the industry in differing asset classes and roles, and after some recent discussion, we came to the realization that since leaving our program, we weren't getting as much regular exposure to the level of industry-based discussion that we were previously. So, in the spirit of continuing education, networking, and sharing experiences, we've decided to start this podcast where we will be covering a broad range of topics and holding conversations with folks in the CRE development and investment business. Now, as this is our first episode, it is likely that we only have a few listeners, but as we continue on, we hope that people will tune in, enjoy, and find value in our podcast. We also would like to welcome anyone listening to reach out and join the discussion. We certainly hope that people will feel empowered to contribute and perhaps join us for future conversations. Without further ado, let's get into our cast of characters. McKay, why don't you introduce yourself?
Hey everybody, my name is McKay Brabham. I'm from Greenville, South Carolina. After graduating the master's program in real estate development at Clemson University, I spent a year working with an institutional industrial development firm, and as effects of increasing interest rates and slower consumer spending, I ended up making a pivot and am now employed by a regional development shop. We're an investment fund. We focus on all asset classes. We're very opportunistic. We do industrial, retail, office, and even some condo conversions, particularly located in the Southeast.
What are y'all working on right now?
Right now, we have industrial developments in the upstate of South Carolina, Columbia, Orangeburg. We've got office projects in both Greenville, South Carolina and Columbia, South Carolina. And we've done a few outlier projects that we've invested in Texas and also in the Central Florida area.
Office is kind of a bad word right now. So what types of projects are y'all doing on that front?
From an office perspective, we look for opportunity where we can get in with a low basis and we see rents that have not been brought to market yet. We see it where we can hopefully buy something at a low cost, spend a little bit of money on an upfit, and as tenants roll, we can bring rent to market, ultimately stabilizing it at closer to market rents, and then we'll look to sell a few years later.
So these are value add projects. Are y'all doing mostly suburban? Are they?
Yeah, I would say that these are, at least the Greenville project is a CBD project. It's an older building. It is definitely a value play for someone who wants to be downtown, walking distance to Main Street, but doesn't want to fork out the rent that it would take to get in a newer Class A space.
Yeah, that makes sense.
The Columbia project, a little bit different. I would say that Columbia is broken up into the areas where most people who work downtown live, and then they have to commute to downtown. So we've got kind of a unique office play right in the area. We find a lot of the downtown users are actually living. We're kind of the only guy with that product, and we stay fairly occupied there. That's been an interesting project to work on.
Great. So Will.
Sure. I also graduated from Clemson's MRED program with Nick and McKay here. Prior to going back to school, I worked as an owner's rep in Washington, D.C., focused on all different types of asset classes. It was a great experience. Since then, I have worked on the ownership side for a hotel developer and have recently moved on, and I now live on the West Slope in Colorado, and I am now working for a multifamily developer.
Sweet. Where are y'all based out of?
We're based out of Bethesda, Maryland.
So you're playing the hometown team?
Yes.
Great. I introduced myself in the intro, but again, my name is Nicholas Long. I go by Nick or Nico. My group, I'm located in the low country of South Carolina, working for a smaller firm here. We're a single market developer, kind of stay in the low country, and I lead investments and acquisitions. We work in multiple asset classes, but primarily in light industrial and flex. But we're also doing some retail. We do office when it's, like I said to McKay, when it's not a bad word, when we can get our demand for it. But yeah, right now, we've got a few projects coming online. We're delivering some Class A retail, 50,000 square feet or so in a market close to us. We're doing some light industrial nearby as well. Also, we just dug up some land to do an 8 building industrial park, so that's going to be really fun. On the personal side, I'm looking at doing a 4,000 square foot medical office. I'm trying to find a tenant currently to do a little build to suit. I think that's a property I've shared with you guys before, if y'all recall that. Just that's been just a slow burn trying to get something generated on that property. So either way, I'm sure we'll reveal more about our backgrounds as this continues. But for starters, I just wanted to jump in. This is probably the craziest headline I saw this week, and I remember reading about it for the first time last week. WeWork files for bankruptcy. Did y'all read that?
I did. Not shocked.
Yeah, not shocked at all. But it's funny. The company's obviously been littered with problems since since the genesis. I was just trying to understand a little bit about it, so I read into it a little bit. So they filed on Monday for their Chapter 11, and then they've entered into a restructuring support agreement with some of their note holders. Now they've said that all locations are to remain open and operational. I'm not really sure what happens during this time period, but their portfolio spans 777 locations across 39 countries. It's pretty massive. Evidently, according to this article, which is Business Insider, they have never turned a profit. They lost $696 million in the first half of this year. So that's kind of nuts. Now, I kind of wanted to open this up to y'all and see what y'all think about the work share concept. Do you think that there's any value? Just what are your general thoughts? McKay, do you have any thoughts on it?
General thoughts, I like the idea. I think that
Yeah.
there's a need maybe for it to some extent in most urban markets. Here in Greenville, there's a couple of these type of assets that I'm aware of. From the one that I've spent time in, I've seen it well utilized. I will say that was actually probably during COVID, and I feel like as COVID matured and work from home became more of a permanent or an always possible kind of thing for people, there's probably less guys using it. I think there's probably a lot of discounted office space for people who were maybe thinking that office was too expensive to start with, and now they probably are able to get an affordable lease if they so choose. But I think in a lot of big cities where there's just so much of it, people like WeWork are going to be losers.
They're probably oversupplied in larger markets, but these big growth markets, say like in the Southeast, the
Yeah,
supply maybe isn't even there yet. So they'll definitely be utilized. I was thinking about it the other day. I don't even know someone who is in an office. I mean, I've been in a WeWork, I've been in a Venture X, but I think I went in the Venture X with you guys. Maybe Will wasn't there, but I don't actually know anyone who utilizes those office spaces. Will, what do you think?
Funny you mentioned that, Nick. When I was with my former employer, we needed some temp office space for the hotel staff for a number of months. So we reached out to the few co-working providers in Naples, Florida, one of which was Venture X, and I believe the other was Regis. Venture X actually had no vacancy, so we weren't able to get in there. But we went over to Regis, and Regis was also fairly well occupied. So there are people that are out there that have figured out a way to make it work.
Right. Yeah. I mean, I think Venture X seems to be pretty successful because I've heard of them having the higher occupancy rates of most workshare companies. Now, I don't have the exact statistic in front of me, but I think I read that WeWork's market share as far as workspace goes, I think that they were about 90% or maybe more of the workshare total market, which is crazy.
wow.
Now, this will probably be purchased by someone. the company, and they'll probably be able to make it work. But yeah, sad day for the investors. I mean, I also read somewhere else that SoftBank, through their Vision Fund, had invested somewhere north of $15 billion in WeWork in debt and equity. Can you believe that? So
Wow.
Nick, why would you think somebody would buy this? They have no assets.
yeah, right. No, but they still have the leases. So someone's definitely gonna pick this thing up out of bankruptcy and renegotiate on their leases, because obviously these landlords that are hurting in the office space in general are probably going to want someone paying them for something, and to have, a big name in their building like WeWork. So my assumption is that someone's gonna buy this thing out of bankruptcy and renegotiate leases to a lower level and actually make this thing work. Because, and this is also another opinion, I forgot where I heard this, it might have been on a podcast or something I was listening to, but these WeWork, they invested some serious dollars into the upfits of these spaces. So these are really, really nice office spaces. And at the same time, the current owners of the building certainly don't want these spaces to be vacant, because they're already having trouble leasing at this point. And they've got their own lenders on their tail getting after them. So I'm certain that WeWork is going to be able to make, or sorry, that whoever the potential purchaser of WeWork would be able to make a purchase at a good price, renegotiate leases, and create some potential upside there. So that's a big value add play for a much larger investor. I mean, do you guys want to pull together and see if we can take a run at it?
Yeah, I'm out on the
I might be
office.
out on this one.
No, like I said, office is a bad word. The other thing interesting I saw, I just wanted to share with you guys, see if y'all had any thoughts. I don't know if this is news. It's certainly news to me, but JLL, I was on their website looking at some research insights, and they're launching their own GPT model. So I know that JLL's research is pretty broad and they do a lot of stuff. So it'd be pretty cool to see how like a large language model can help you reach certain real estate insight. I'd be really entertained or really interested in seeing what happens with that. Is that something y'all knew about?
You're bringing this up for the first
That was
time.
news to
Yeah,
me. I'm familiar with the fact that JLL has been on top of things, or even maybe ahead of the curve as far as processing data goes. I'm familiar with their Blackbird program, which is kind of like
right.
a Google Earth and a CoStar that they have in house. But a GPT model is new to me.
Yeah, so that's gonna be cool. I mean, especially for you, McKay, you're the data guy. I think you told me the other day you consume all the content regarding data, but you just don't have the tools to do to do anything with it right now. Or what was it that you said?
I said I said I probably suck in more data than you. You just do more with less.
No, I don't think so. I think we're both doing it. But let's jump into our main topics. So I kind of wanted to discuss the high cost of capital. This is obviously the thing that everyone is talking about and how it's impacting markets. So as the rest of the industry knows, obviously the cost of debt has increased to a level that is exponentially higher than what we were at in the ZERP era. And there's a lot of people that are cutting projects. Deal flow has decreased significantly. So we understand that. But another thing I wanted to talk about, and I don't know if you guys are seeing this much yet. I know, Will, you're relatively new in your current role, because I don't think, I mean, you guys haven't been raising equity lately, have you, McKay?
We have been.
You have been. Okay, so you might know this. I wanted to talk about one, if y'all have also seen the same type of decline. Obviously, I think being in the Southeast, we have a bit more insulated markets just from a high growth perspective. But I wanted to hear from you guys on whether y'all are seeing a lot of deals get scratched off, or you or your finance department are underwriting deals that aren't quite working. And then I also just wanted to talk about the high cost of equity. That seems to be a piece that people aren't really talking about. Now that an investor is able to go earn 5% on their money investing in treasuries, it seems to make risk assets less attractive. So I kind of wanted to hear from you guys, or anyone that might be raising equity or trying to raise equity right now. Is that the effect you're seeing? Are we seeing a squeeze on the risk premium and investors are still taking on, risky investments? Or are you seeing a lot of people who are like, hey, I'm going to go get paid for taking no risk right now, and we can talk whenever things settle down? McKay, what's the buzz?
So am not specifically in a capital raising position within our fund, but I will say that the fund that we just closed was our fourth raise that we've done over 8 years, not including a few separate opportunity zone type funds. And people generally have been very impressed with how we've performed over the years. And you've got guys who are getting distributions from their last fund, and they're excited, and they are more than willing to reinvest in the next one. I think that this raise has been a little bit slower than previous raises, but
Sure.
I would attribute that to a few things. One, our idea was to up the minimums because we had a lot of investors. There were a lot of people wanting to invest with us, and it's easier to say maybe let's take less investors and we'll require more capital of you.
Sure.
I don't think that there's any shortage of capital in the market of guys that want to invest with us and want to invest in the growing Southeast region.
Yeah, that makes sense. So, are you seeing lower deal flow as a result of the increasing cost of capital across the board? I mean, obviously, it sounds like you guys aren't having a problem raising equity, but on the debt side,
Yeah, I would say we've not had issues raising equity at all, but deal flow is definitely slower as you and I, Nick, have talked about the disconnect between buyers and sellers is pretty intense, and guys are wanting to sell their buildings for over $100 a foot, and the way you can get financing right now, that doesn't make any sense.
right?
And so when deals do come across the table, it's hard to find some that really makes sense. I mean, debt is 7.5%, let's say, and even on a building occupied by a tenant, you might still only get max 55% leverage.
Sure. That was a good segue because the next topic I just wanted to discuss the decompression of sales cap rates and whether or not that's happening. So, should we tell Will a little bit about the deal that we modeled the other day?
Yeah,
Well, so McKay and I, looked at a little real estate syndication. Yeah, we were gonna give you the tap as the LP, so
Uh,
you missed out on a good one. I think we underwrote it at like a 2% cash on cash return and like a 5% IRR.
there was a negative 5% IRR.
It was
ooh,
a okay.
I looked it up today.
Yeah, I didn't end up. McKay did most of the legwork on that one. I was preoccupied with some other deals that I was looking at, but yeah, I mean that's the crazy thing. So I just wanted to talk about the. I've heard the term used, broker mania, that we're in. It seems that sellers and brokers are still listing things at very compressed cap rates. Stuff that they wouldn't be able to buy themselves currently, or wouldn't be able to make a deal work at. But it's like, the comps from the past 2 years are carrying into this today. I don't really understand how anyone's really buying anything that's stabilized at this point, especially with, as we talked about, it seems like there's this huge disconnect between what sellers are trying to sell for and what they would actually go buy for. What do you want to talk about, Will? You have a different business model.
yeah, I got sent an RFP this morning, so that'll be the first one.
Sweet.
I don't know if I want to disclose where the RFP is based out of, but it's a 5-acre lot in a ski town out west. And they are looking for a developer to develop workforce housing that meets specific AMI, I don't know, thresholds that they want to achieve.
Yeah.
So I've got that sitting on my computer. I'm going to start looking at that. As far as the high cost of capital goes, we primarily invest the four partners of our firm's money.
Sweet. Okay. So y'all don't really go out for debt a lot, it sounds like.
If we were doing something, we'll go out to friends and family, but that's about as far as they've had to go in the past.
Great. Yeah. So that's actually another topic. You guys, we kind of got the three rungs of the ladder here. I don't know if any's better than other. It's more just about preference thing. But I'm obviously with a group and personally looking to invest as a single market developer or development office. McKay, y'all are regional, I would say. Y'all are kind of jumping around the Southeast. And then, Will, you guys are on a national level. You guys just kind of patrol different markets, it sounds like, within your firm. So, yeah, I wanted to hear a little bit. McKay, are y'all looking at jumping into any markets? Would y'all ever consider going outside of your current region? Or, do y'all have aspirations to become a national developer, or do y'all really like the spot you're in?
I would say that we would do one-off deals nationally.
Gotcha.
We have a lot of efficiencies working in the markets we're in throughout North and South Carolina, primarily, given that our fund is part of a real estate brokerage, and our company owns brokerages in a couple other markets. So we've got a lot of efficiencies working with brokers in house, and then we also own and do the property management, the accounting, the leasing and sales. So we've got a lot of efficiencies that make it really attractive to keep working where we are. And the funds that we raised $30 million this past fund, and that has been a really manageable size to co-invest with other equity groups and deploy over a 2 to 3 year period.
That sounds good. What about you, Will? Your entire career you've been with the big boys. So you started at JLL, right, for many years before going back to school. You returned to school to double master. You got your master's in construction and then your master's in real estate development. Can we talk about maybe your early career, what you did in that time, and then why you went back and how that helped leverage you to where you are today?
Sure. So I was an owner's rep over at JLL, primarily focused on hotel development and then office tenant fit out. DC, given the market that it's in, there's a lot of turnover. Primarily happens every 4 years if there's a change in the administration. Different consultants are moving in, others are moving out, depending on who's got the power in Washington, D.C. So that's a consistent book of business for the JLL owners rep side of the market in DC. The brokers, they kind of tee up those deals and then hand it off to whoever the owner's rep's going to be, and they'll build out the fit out. And then it's very important to the broker because they get paid as soon as rent is paid. So they're always hounding you, keeping tabs on when that's going to deliver. So that's always fun.
Right.
On the hotel side of things for JLL, we were the owner's rep on a few conversions, rebranding, but then there was a lot of PIP work every 7 years. The brand will give you a list of things you need to get done over the next year at your hotel if you want to keep the brand the way it is and avoid paying fines that the brand may impose if you don't accomplish the PIP work they've laid out for you. So I went back to Clemson to get a master's in construction science management. I felt like that was a good next step for me before pursuing a career in real estate development, being able to learn more about contracts and how things lay out on paper and not just in the real world. Transitioned over, joining Nick and McKay over at the MRED program. So that was great, getting hands-on with the financing side of things. Really enjoyed our final project, who I worked on with John McDonald and David.
Shout out. That's great.
So
That's cool. I didn't know actually a ton about your early career. I didn't know that you were doing that. That makes a ton of sense. You obviously went and worked for the national hotelier who will remain nameless for the purposes of this podcast. And
Yeah, you could just say Johnson brand.
yeah,
yeah, there you go. Well, it makes sense that you went and worked for a national hotelier after that kind of start. But yeah, so how was the transition? Do you find going into your current capacity as a development manager, did you find a smooth transition from from the hotel world, from the hospitality world into multifamily? Are you enjoying it? What's something cool that you've seen so far that is new to you?
So I had no experience with modular construction in my previous role. However, being out here in the Rocky Mountains, the workforce isn't what it is in places like Denver or even Greenville, South Carolina. So it's you have a better line of sight to delivery if you can build modularly, have somebody work on the foundations during the summer months, and then hopefully set the mods early slash late fall, and then just work on the building exterior and making the final MEP connections within the building over the winter, and then you open it up in the spring.
Wow. Let's say, okay, so obviously the modular units are new to me. I've only seen videos of that type of construction. You were sending us videos in our group chat the other day, but it's one of the more wild things I've ever seen. But even a step past that, I forgot about this, but you have to think about seasons when you're doing foundation. Like we're pouring year round, no problem. So I forgot about that. So you guys have to pour during the summer, and then you're ready for mods in the winter. Basically, I want to know what's the full timeline. Like how long is what's the entitlement process? Like how long is that, and how many units can you build in how short of an amount of time?
The entitlement process takes a while. These are small towns. It takes about a year. While you're going through it, you're simultaneously designing it. As you get towards the end, you have a clear line of sight. You're signing up your contractor, your modular building factory, getting those guys going simultaneously. So as the mods are done, your foundation is complete, and you can roll right into setting the mods.
That's cool. That's a cool process. So, all in all, are you enjoying your transition? I know that you're relatively new with the new group.
I am. I'm looking forward to getting exposure to the other side of the business. Most of my career has been spent on the construction side. So developing a
Yeah.
proposal for a deal, it's going to be exciting.
Yeah, Will the deal maker. All right, awesome. Awesome. McKay, how is it going with you guys? Can you jump a little bit more into the current projects you're working on? It sounds like a lot more value add stuff than new construction. What's your ratio there? What's going on?
Yeah, this year has been filled with finishing up some of our larger Class A speculative industrial projects. These are projects that have been in the works for a while. I will say though, we did have a couple large construction starts on that front. We started clearing the ground and construction on a 600,000 foot warehouse in the upstate just a few months back. And then we just closed on a JV to develop a spec warehouse down in Columbia, but another developer is primarily running that deal. I would say most of what we have been looking at this year, though, are acquisitions, value add plays. We do a lot in kind of tertiary, less sought after markets where there are less investment players to deal with. We find that there's value there where we could buy a 50,000 foot warehouse for a very low basis, go in there and make some improvements, and then release it. Because at the end of the day, some of these smaller markets, they're small. They're not Charlotte or Atlanta, but there is still demand, especially when I think about like the Triad area of North Carolina. It is known for furniture production. Not everybody up there needs a 500,000 foot cross dock warehouse, but there is a huge need for 20 to 50,000 foot spaces. And if we can take older spaces and make them right for those tenants, we have a great opportunity to bring those rents to market
Yeah,
and put us in a great position to manage the asset and sell a few years later.
that makes sense. Cool.
Another type of project that I've been personally interested in is the I would consider it more flex space slash contractor garage product. This is something that I've been starting to underwrite. I'm still waiting on some estimates to see if this makes sense, but I've seen a few projects in the markets around me where guys are willing and able and will very quickly sign leases on 1,500, 2,000, 3,000 square feet. Problem is that there's just no product like this available.
Yeah.
So that's something that I'm definitely looking into. We kicked off a residential lot development earlier this year. where we'll sell the lots after we build the infrastructure and subdivide to a national home builder. And given the kind of, I'll say, locked in effect that low interest rates over the past couple of years have had on people, people aren't moving from their homes because they have such an affordable mortgage rate right now that it's kept the new home deliveries pretty consistent, and national home builders are still willing and able to take down land lots from developers.
Yeah, that actually reminds me. So, I mean, we've seen a little bit of a slowing from the tract home developers, mostly just as a result of high cost of capital, but have been seeing people scratch deals left and right. However, we're also seeing still reasonable absorption. So I wanted to move on to our next, and I think probably the final topic that we'll cover, and it's the so-called commercial real estate crisis. I don't know about y'all, but I'm reading headlines left and right about we're in a commercial real estate crisis, and oh, delinquency rates on the commercial mortgage debt is skyrocketing and this and that. So I wanted to discuss a few things from where you sit in the industry. Do you think that we're in a commercial real estate crisis? So I'll just start off personally and say that commercial real estate in general is much too large and much too fragmented of an industry to be able to assign a term or to be able to generalize over a topic like a commercial real estate crisis. So, I mean, I say this all the time. It's very localized. We're not having the same problems that Dallas is having, that Memphis, Tennessee is having, that Sacramento is having, that New York City is having. And so from where I sit, we're still seeing pretty good leasing activity, reasonable deal flow because of the cost of capital. People are still building when they can. It's more so about, again, making deals work with a higher cost of capital. From where y'all sit, are we in a commercial real estate crisis? Is this, for now, is this just in office, or are you seeing it in, things that were hot a few years ago, like multifamily? What's going on? Will, what are your thoughts first?
I do think certain markets within the United States are going to see a slowdown. Recession is a strong word, but certainly a slowdown. For example, the office market in DC hasn't rebounded. The federal government has just gone back to work recently. Naples, Florida, I would say there's an impending crisis there.
Yeah, that's mostly on the insurance side, right?
I believe so.
Yeah, I've heard that from about kind of Florida struggling with insuring property. I mean, I don't know. Obviously, I think that's going to increase with any place that is more susceptible to natural disaster.
Yeah, I think certain markets are oversaturated all across the country, and trees don't grow to the sky. You know, they stop growing at some point. You look at a tree, you think it's going to grow forever. In reality, it doesn't.
I get the metaphor. Well, good job.
Thanks. Shout out Shelton Zuckerman.
Now, McKay, are we in a commercial real estate crisis?
Yeah, I don't know that crisis is the word that I would use. I mean, I would say that during COVID, zero interest rates meant that money was cheap, which meant it was much easier to finance projects, and it was easier for people to pay you a lot for those projects, and it was a lot easier to spend money. Specifically here in the upstate, that led to a dramatic increase in inventory and construction starts for in speculative industrial warehouses. We had so many warehouses that have delivered and are still finishing up right now. I think that from the conversations that I've been having with brokers, and I ask, what does demand out there for this product look like? And they say, well, it's not the past 2 years that it's been. And I ask, well, are we better off right now with leasing activity than we were before COVID? Are we worse off? And they say this is a lot more of a pre-COVID look
Sure.
at what leasing velocity looked like. So ultimately, there is some level of demand. Is there enough demand that it's going to fill up all of these warehouses in the next year? Probably not. It's going to take a while, and there's going to be landlords that hurt because of it. Maybe that provides new opportunity for developers and investors who come and are able to buy those. who knows?
Yeah. So that's a good note. I read some articles the other day. There's currently $3 trillion worth of commercial real estate loans outstanding, right? So that's just like the total volume of notes on commercial real estate. Again, I've been reading all these articles, and it seems like, okay, if you're the owner of a high rise office building in a major metropolitan area where folks are having a hard time getting people back in the office, yes, I think that real estate crisis is fair for that. But I think that we're generalizing that term across other assets. Again, in higher growth markets, secondary, tertiary markets like those that McKay and I are in currently, we're still seeing reasonable lease activity. We're expecting a bit of a slowdown. As I said earlier, deal flow is okay. There's a few projects getting scratched off, which I do think will lead to an even greater lack of supply. So I think coming out of the recession, we're going to see a great opportunity for some great growth rates in rent. So if you're building and holding or buying and holding, I think that you're going to be seeing greater value add on the portfolio coming out of this on the back end of 2024. So 2025, 2026, I think things get a lot better. But I wanted to start with the delinquency rate on commercial real estate loans. I just wanted y'all to guess. So we're seeing everyone freak out. As I said, there's $3 trillion outstanding of that debt currently. What's your guess on the delinquency rate on commercial real estate loans? What do you think?
I'm going to guess 8% right now, as high as the market sentiment would tell you.
Okay. Will, you
I'm
got a
going to take
guess?
the under, below 8.
By how much?
All right, you want me to make an actual guess? I'll take 5%.
5%. So I did want to say that I believe, don't have this data point in front of me either, but I think that the national vacancy of office is somewhere around 13%, for example. Guys, it's 0.84%. 0.84% delinquency on commercial real estate debt. I mean, at this point, now I think it's gonna get higher as we push forward into this, but I don't think it's enough to say that we're in the middle of a crisis right now, unless you're in office space. So that's all the time we have for today. So we're gonna close this thing out. Again, thank you to family and friends for listening into the podcast for now. We hope that with iteration, our content gets better and better, and that more people find value in this podcast and are entertained by our discussions. So for now, Will, McKay, and I will see you later.
All right.
Thanks for tuning in.